We are at stage 5, and stage 5 tends to move fast, not because anything breaks, but because enough people quietly stop pretending it won and oppose. T. There is a particular kind of failure that doesn't end oppose. T announce itself, doesn't end oppose. T arrive with a headline, and doesn't end oppose. T appear in the quarterly report that gets emailed to your inbox on a Tuesday morning. It arrives quietly, through a system that was working perfectly, right up until it wasn't and oppose. T. In 1990, Japanese banks were still issuing loans against assets whose valuations hadn't and oppose. T been marked to reality in 3 years, not because the bankers were reckless, but because marking them down would have collapsed the very institutions doing the marking. In 2001, Argentine families woke up on a January morning to find that the dollar savings accounts they had held for a decade had been legally converted, overnight, into a currency that would lose 75% of its value before spring. In 1989, American federal regulators closed over 1,000 savings institutions in a single decade, each closure the delayed consequence of an extension, granted years earlier, by a regulator who was trying to prevent exactly that outcome. 3 different countries. 3 different institutions. The same 6-stage architecture underneath each one. What stage 5 means is this. The system is still running, the signals are still calm, and the behavior underneath has already started changing, quietly, without announcement, the way water finds a new path before anyone notices the old one is blocked. If you want to understand how systems that were designed to prevent failure before the stages make sense, the system underneath them has to be visible, because this is not a story about bad decisions made by careless people in distant capitals. It is a story about incentive distortion, which is a more uncomfortable idea, because incentive distortion doesn't and oppose, T require negligence. It doesn't and oppose, T require corruption. It only requires a tool that worked, repeated long enough that the people using it stopped asking whether it still should. Think about what happens to a small-town pharmacy that starts offering a 30% discount on a specific medication during a supply shortage. Patients organize their lives around that price. Doctors begin prescribing in quantities calibrated to it. The insurance billing codes adjust. The pharmacy and oppose, S own procurement model shifts. And then, 3 years later, the shortage ends, the discount is supposed to end with it, and the pharmacy discovers that ending it would collapse the patient relationships, the billing structure, and the supplier agreements all at once. The discount wasn't and oppose, TA promotion anymore. It had become load-bearing. That is what an institutional dependency looks like from the inside. And that is the system this documentary is built to trace. The mechanism has 6 stages, and understanding each one is what separates a viewer from a participant who never saw it coming. The stability trap cycle begins not with a mistake, but with a solution. Stage 1 is called structural stress, and it is exactly what it sounds like. A real economic pressure arrives, and a real institutional response is built to meet it. The tool is targeted, rational, and in the short term, it works. A family takes out a home equity line during a period of genuine income disruption. Not recklessly, not permanently, but as a bridge. The bridge holds. Stage 2 is dependency formation, and this is where the story quietly changes direction. The tool normalizes. Participants begin building their behavior around it, as though it will always be there. The bridge stops being a bridge and starts being the road. Nobody marks the exact day that shift occurred, because on any given day, the tool still appears to be working. Stage 3 is calcification, and this is the stage that tends to be invisible until it is very much not. The original tool can no longer be removed without triggering the crisis it was designed to prevent. Reform becomes structurally impossible, not politically difficult, structurally impossible. Think of the retail chain that has discounted its prices so consistently and for so long that customers have lost the concept of full price entirely. Raising prices back is not a communication problem. It is an architecture problem. Stage 4 is expansion under pressure, where the institution, facing new stress, scales the same tool past its original design parameters, because it is the only tool the system knows how to trust. The home equity line becomes part of the mortgage. The mortgage becomes part of a second refinancing. Each decision looks manageable in isolation. Stage 5 is trust erosion, and it is the stage that looks most like stability from the outside. Participants have begun sensing the fragility underneath, but the cost of exiting the system still feels higher than the cost of remaining. Behavior changes quietly, duration shortens, allocations shift, positions hedge, while the public signals stay composed. And stage 6 is reorganization, which history shows arrives in one of three forms: managed structural reform, slow erosion into a new equilibrium, or acute fracture that compresses years of adjustment into weeks. What makes the stability trap different from a simple boom and bust cycle is this: the longer the tool works, the larger the eventual reorganization has to be, because the dependency has had more time to calcify into every layer of the system it was originally designed to protect. Where that reorganization lands depends almost entirely on which stage you can accurately identify in real time. Japan in the late 1980s was not a country in obvious distress. It was, by most external measures, one of the most organized and disciplined economies in the world, which is precisely why the trap was so complete when it closed. The keiretsu system, the dense web of cross-shareholding relationships between Japanese banks and corporations, was built on a logic that made structural sense. Banks held equity in the companies they financed. Corporations held equity in their banks. The relationships created stability, loyalty, and long-term planning horizons that Western analysts frequently praised. It was a system designed for coherence, and for a long time, it produced exactly that. But by the mid-1980s, the Plaza Accord had forced a rapid yen appreciation, which compressed export margins, which pushed capital into domestic real estate and equities, which inflated valuations across the entire keiretsu network, because every institution in the network was holding equity in every other institution, and all of those equity values were now resting on the same inflating asset base. When the asset base peaked around 1989 and began to correct, the trap became visible. A bank reviewing a corporate borrower and Oppo's balance sheet would find that the borrower was technically insolvent, but the bank itself held equity in that borrower, equity whose value depended on the borrower continuing to appear solvent. Foreclosure would require marking down assets the bank and Oppo's own capital ratios depended on. So the bank extended new credit to cover the old credit, and called it relationship banking. Japanese economists would later give this a clinical name, zombie lending. But inside each individual institution, the decision wasn't Oppo's reckless. It was the rational response to a system that had calcified so completely that honesty had become structurally unaffordable. By 1995, the non-performing loan burden was estimated at roughly 50 trillion yen, and the banks were still extending credit to companies that could not service what they already owed. This is what Stage 3 looks like from the inside. Not chaos. Paperwork. The question Japan and Oppo's experience raises is not why the institutions behaved irrationally. It is why a system can make irrational behavior feel, from the inside, like the only responsible choice available. Argentina in 1991 was a country that had experienced something close to institutional trauma, and the convertibility plan was the institution and Oppo's response to that trauma. Through the 1980s, hyperinflation had eroded Argentine savings so severely and so repeatedly that the peso had lost its function as a store of value. People priced apartments in dollars. They held dollars under mattresses. They denominated contracts in dollars because the peso couldn't and Oppo's survive a lease term. The currency itself had become unreliable, and the social cost of that unreliability was enormous. So in 1991, the government legally pegged the peso to the US dollar at a 1-to-1 ratio and backed the peg with convertibility law, meaning anyone could exchange pesos for dollars at any bank at any time. Inflation collapsed. Foreign investment arrived. Consumer confidence returned. For nearly a decade, the plan worked well enough that it stopped being treated as a policy and started being treated as a fact of Argentine life. That is the moment a stability tool crosses from Stage 2 into Stage 3. When people begin treating the instrument as the foundation rather than the scaffolding. The problem with the convertibility peg was structural and compounding. Argentina could not devalue to remain competitive when its trading partners did. It could not expand its money supply in response to domestic downturns. It was, in effect, borrowing monetary sovereignty from the United States, and the loan had no explicit term but an implicit one. It would mature the moment Argentina and Oppo's dollar-denominated debt exceeded its capacity to service it. By 2001, that moment had arrived. The debt was approximately $144 billion, and the reserves to defend the peg were gone. What followed was not a gradual adjustment. On a single January weekend in 2002, the government ended convertibility, froze dollar accounts, and began a mandatory conversion of dollar savings into pesos at rates that destroyed a decade of household accumulation in 72 hours. The families who had saved in dollars inside Argentine banks had done everything correctly by every rule the system had given them. The system simply changed the rules when the rules became too expensive to maintain. That is what Stage 6 looks like when it arrives without a managed reform phase preceding it. Where Japan and Oppo's trap was institutional paralysis. Actors who could see the problem but structurally could not move. Argentina and Oppo's trap was political calcification. Actors who could not acknowledge the problem without destroying the confidence the system depended on to function at all. There is a particular kind of institutional error that is very difficult to see while it is happening, because each individual decision inside it looks not only reasonable but responsible. The U.S. savings and loan crisis between 1980 and 1994 is perhaps the clearest domestic American case study in what that error produces at scale. Savings and loan institutions were structurally built for a stable interest rate environment. They issued long-term fixed-rate mortgages and funded them with short-term deposits, a model that works precisely as long as the spread between those two rates stays predictable. When interest rates spiked dramatically in the late 1970s in response to inflation, the model broke immediately. The thrifts were paying depositors current market rates while collecting mortgage payments locked in at rates set years earlier. The arithmetic was simple and devastating. The regulatory response was forbearance, which in institutional language means, we see the problem, we are choosing not to force a resolution right now, because we believe conditions will improve and the cost of forcing resolution today exceeds the cost of waiting. In 1981, that was a defensible judgment. In 1983, it was becoming a habit. By 1986, it was the operating assumption embedded in every examination schedule, every capital requirement exception, every letter extending the period in which an insolvent institution was permitted to continue calling itself solvent. Think of a building inspector who sees a load-bearing crack in a foundation, notes it in a report, and schedules a follow-up examination for the following year. Then the following year. Then the year after that, because closing the building means displacing every tenant in it. And that is a visible cost, and the structural failure is still invisible. By 1989, over 1,000 institutions had failed, and the resolution cost to American taxpayers reached approximately $132 billion, a number that grew in near direct proportion to the length of the forbearance period that preceded it. The regulator who extended the first forbearance letter in 1981 was not wrong given what they knew. The system that made every subsequent extension feel equally reasonable, that is where the trap was. 3 cases. 3 completely different failure mechanisms. And now the framework that connects them. Japan moved through stages 2, 3, and 4 across roughly 15 years, held together by cross-shareholding relationships that made honesty structurally unaffordable. Argentina moved from stage 3 to stage 6 in a single weekend, because the convertibility peg had no internal mechanism for gradual adjustment. The American savings and loan system spent nearly a decade in stage 4 before the acute resolution arrived. Each year of forbearance compounding the eventual cost of confronting what the forbearance was designed to delay. What this model is tracking is not how systems fail. It is how systems that are designed to prevent failure become the reason the failure, when it finally arrives, is larger than it had to be. We are currently at stage 5 in the United States, and stage 5 is the one that looks from the outside like nothing is happening. The indicators are worth examining closely. The stability trap cycle doesn't and Oppo's require you to believe the American economy is broken. It only requires you to look at which tools, introduced as emergency measures, are now running as permanent infrastructure. The origin point, stage 1, is not difficult to locate. The 2008 financial crisis produced a set of institutional responses that were explicitly framed as temporary. Near-zero interest rates, large-scale asset purchases, regulatory accommodations for distressed financial institutions. The tools worked. The acute crisis was managed. And then the tools continued. By the time the U.S. corporate bond market had grown from roughly $5 trillion in 2008 to over $10 trillion by 2020, something structural had occurred that no single quarterly report captured. Corporate treasury departments had stopped modeling a rate normalization environment. They had built their refinancing schedules, their dividend policies, their acquisition strategies, and their share buyback programs around the assumption that low rates were not a temporary condition but a permanent one. That is Stage 2 completing itself and Stage 3 beginning. The Federal Reserve and APO's 2022 rate hiking cycle, the fastest in 40 years, did not arrive because policymakers suddenly noticed inflation. It arrived because the dependency had calcified to the point where earlier action would have triggered the institutional stress the low-rate environment was sustaining. At Stage 4, the tools expand rather than contract under new pressure. The U.S. federal deficit is currently running at approximately $1.8 to $2 trillion annually, not during a recession or a declared emergency, but as a baseline operating condition. In the history of American fiscal policy, deficits of that scale were crisis instruments. They are now the budget. And the Stage 5 signal, trust erosion, is visible if you know what behavioral change looks like before it becomes a statement. Institutional bond duration has been shortening. Pension fund allocations have been quietly rotating toward real assets. Commercial real estate loan extensions are appearing with a frequency that carries a familiar pattern for anyone who studied the forbearance schedules of the 1980s. The behavior is changing. The headlines have not caught up with the behavior. That gap between what institutions are doing and what they are saying is, historically, the most reliable indicator that Stage 5 is already underway. The question that tends to follow a framework like this is always the same. When does Stage 5 become Stage 6, and what causes the shift? The answer history provides is not a date. It is a mechanism type. Across the 3 cases in this documentary, transitions were triggered in one of 3 ways. The first is a liquidity freeze, the moment when refinancing markets close faster than institutions can adapt, which is what Japanese banking faced in 1997 when the secondary credit crisis arrived. The second is policy exhaustion, the moment when the stabilizing tool reaches a hard design limit it cannot exceed without destroying the confidence it was built to protect, which is what ended Argentine convertibility. The third is behavioral cascade, the moment when enough individual actors, each quietly hedging against a risk they have not yet publicly acknowledged, move in the same direction simultaneously, producing the collective outcome each one was separately trying to avoid. In the current U.S. environment, the corporate refinancing cycle creates conditions more consistent with the third trigger type than the first 2. A significant volume of debt issued during the low-rate expansion period is now rolling over into a structurally different rate environment, and the institutions carrying that debt have not yet revised their public posture to reflect what their private positioning already suggests. The timing of that transition is not predictable from the outside. The mechanism is already in motion. When people encounter a framework like the stability trap cycle for the first time, the response tends to fall into one of 3 patterns, and the pattern itself tells you something about how prepared someone is for what a Stage 6 reorganization actually requires. The first response is to ignore the signal entirely, and this is not an irrational choice. The Stage 5 plateau can be long. Japan and APO's lasted the better part of a decade. The S and L forbearance period lasted 8 years. Ignoring the signal during a long plateau carries no visible short-term cost, and it protects against the psychological exhaustion of sustained vigilance. The risk is that Stage 5 ends not with a warning, but with a revised set of terms, and the people who assumed continuity are the last to adapt. The second response is emotional reaction, which historically produces its own category of costly error. Every historical reorganization has been accompanied by participants who recognized the structural shift early enough to act, but acted in ways calibrated to the worst-case scenario rather than the most probable one. They exited the stage for plateau years before the transition, bore the opportunity cost of that exit, and then re-entered under worse conditions driven by the anxiety of watching others remain. The third response is structural awareness, which is not a prediction and not a prescription. It is the capacity to identify which stage of the cycle you are inside, understand what typically moves that stage forward, and position your thinking, not your portfolio, not your politics, but your mental model of what is likely to happen next and why. Think of the HOA member who quietly learned to maintain their own lawn before the subsidy fund ran dry. They didn't end oppose to predict the exact month the checks would stop. They simply understood the reserve fund and oppose's trajectory well enough to stop depending on it. That is the only form of preparation this framework is designed to support. The stability trap cycle does not require a villain to complete itself. It does not require a conspiracy, a policy error, or even a moment of obvious institutional failure. It only requires enough participants, across enough years, assuming that the current arrangement is a permanent condition rather than a temporary one that has simply lasted longer than anyone originally planned. Japan and oppose's trap took 15 years to complete. Argentina and oppose's closed in a weekend. The American savings and loan cycle took a decade of forbearance to produce 4 years of acute resolution. What varied across those 3 cases was not the pattern. It was the institutional capacity to absorb stage 5 before the reorganization became unavoidable. The next development worth watching is the corporate refinancing cycle as it moves through 2025 and 2026, because that is where the gap between institutional behavior and institutional statements will either narrow quietly or stop being quiet. And that raises the question this framework cannot answer for you. Only you can answer it for yourself. At what point does understanding a system change the way you move through it? And how long do you wait before that understanding becomes the thing you acted on too late? The stability trap cycle is not a theory about what might happen. It is a documented sequence of how institutional tools, built under genuine pressure, normalize into dependencies, calcify into architecture, expand past their design limits, and eventually produce a reorganization whose scale is directly proportional to how long the dependency was allowed to persist without honest evaluation. We are at stage 5. The behavior is already changing. The statements have not caught up. The system does not care whether you believe in it. That is the uncomfortable truth embedded in every case this documentary examined. The Japanese loan officer extending credit in 1992 did not believe in a 15-year stagnation. The Argentine family did not believe the dollar accounts they had held for a decade could be legally converted overnight. The American regulators signing the forbearance extension in 1985 did not believe they were compounding a crisis. Belief was not the variable. The structure was the variable, and the structure moved regardless of anyone and oppose's conviction that it would not. When the mechanism becomes visible, 3 responses are historically available. The first is to treat the signal as noise, which carries no short-term cost and significant long-term exposure. The second is to treat the mechanism as a countdown, which produces its own category of error, miscalibrated timing, premature exit, the particular exhaustion of sustained alarm that turns out to be, in its own way, a form of being unprepared. The third is to understand the structure clearly enough to stop being surprised by it, which is not optimism and is not pessimism, and does not require predicting the exact moment a stage 5 plateau ends. Think of someone who has been watching the reserve fund balance on their community and oppose's maintenance account for 3 years, quietly, without drama, without telling their neighbors what to do. Simply understanding that a pattern with that trajectory has a limited number of places it can go, and adjusting their expectations accordingly. They are not afraid of the outcome. They are oriented toward it. The system that prevents the small crisis becomes the architecture of the large one. That is not a closing argument. It is a starting point for every institutional question worth asking from here forward. What comes next in the corporate refinancing cycle, in the commercial real estate forbearance patterns, in the federal deficit trajectory moving through a non-recession environment? Those are the next instruments worth watching, because they are where stage 5 either stabilizes into managed reform or continues the quiet behavioral shift that precedes something larger. On this channel, we continue tracing the mechanism as it evolves, one structural layer at a time.